welcome to OK Computer. I am Dan Nathan. I am joined with one of my favorite return guests. That would be Dan Niles. He's the founder and portfolio manager at Sotori Fund. Dan, welcome back to the pod.
Thank you for having me back on, Dan.
You are a listener favorite, just so you know. Many of our listeners, we spend a lot of time on private markets. We talk a lot of thematic sort of things in and around tech. And, for me, I think my kind of fast money hat. You and I met, I think, a couple decades ago. I was a fast money trader on the street at the time. I love talking markets. I love talking about what might happen next, that sort of thing. But I also like talking big picture with folks like you. You've been covering tech for again, since the 90s, and you have a tremendous perspective, but you also have a very interesting macro perspective. And now you don't just trade tech or just invest in tech. And we're going to talk a little bit about these GLP-1s. This is an area that is near and dear to my heart. And so I find it interesting that we found those in your notes. So we're going to get to some single stocks. We're going to get to some tech stuff. But I really want to start with the macro because I saw a tweet, and I didn't see it on Twitter because I'm no longer on Twitter, but one of our team members forwarded it to me. You have this amazing transparency. You put it out that you had been bearish and you had many single stock shorts on, but you had been covering them. I think this was on October 4th or so. And despite having a sort of bearish intermediate to long-term view, you just thought things got a bit oversold, I'm assuming, and as we're getting into Q2 earnings season. So give me a sense of kind of where you are. What were some of the shorts that you had taken off, and how are you thinking about the environment right now? Because, we have a yield, and we got to talk about yields too, because, if you just look at where we are right now with the 2-year, the 10-year, with where Fed funds are likely to go between now and the year end, maybe it's another 25 basis point higher, which would be at a 20-some year high. The fact that stocks are trading the way they are this last few days is really confounding to me.
Yeah, so you're right. So if you go back and you look on the morning of October 4th, we put out a tweet and it basically said, on average, we have about 50% of our portfolio short. Because remember, I'm a hedge fund. And so over a long period of time, we have roughly 75% plus longs, close to 50% shorts. And then so you get to that 25% net exposure because it's an all-weather fund that we. So it's, low gross, low net return over time. So for us, when we put out that tweet on October 4th, instead of having 50% shorts, we got it to less than 5. That's obviously a big, big change for us in terms of how bullish we are through year end. And as you rightly pointed out, it was based on a lot of technical metrics. And so we track over 20 of them in a proprietary model we have. And these are just pure technicals, nothing to do with fundamentals. And learn to pay attention to that over time. And if you look back over the last several years, you'll see that we'll put out, short-term things where we're covering a lot of shorts or putting a lot back on. And it was really, the market had gotten really oversold. And seasonally, Q4 is the best time of the year to own stock. And so you combine those two things, and our view was the market's going to have a short-term rally, probably last through the fourth quarter. But in 2024, that's where we have concerns based on the longer term things that we're watching for. And so I call it, Goldilocks in Q4 meets the three bears in 2024. And in 2024, you're dealing with 25 million people having to restart repaying student loans, oil seeping into inflationary metrics, and then higher for longer, people really having to focus on that. And that's inflation, Fed funds rates. And so all of that sort of tied together. And so that's kind of a short-term versus long.
Yeah, well, let's talk a little bit about the shorts, because when we last spoke, I think it was early August, and at the time, I think you were less than impressed of what you heard from Q2 results and Q3 guidance among many sectors in the market, but specifically some tech names. And when I think of the two biggest, I think of Apple and Microsoft. From their highs in July, in and around earnings, to their lows in September, they were both down about 15%. The S&P was down about 8%. So you just talked about how your book was about 50-50 long short, which most hedge funds, that is a high short conviction, correct? If you were at 50% shorts. And so I'm curious, how did a lot of those shorts perform? Because I know that your performance has been really great in the fund over the last 2 years. I believe you had a good year when the market was down in 2022. Also, did you get a lot of outperformance by your shorts during that period where you were particularly bearish into that October 4th tweet?
Yeah. So, last year, it's sort of out there. Fund was up. Obviously, NASDAQ was down over 30% and the S&P was down, close to 20%. We made money in the fund in July. We made money in the fund in August, and knock on wood, I'm probably jinxing myself, but we're making money so far in September. And to your point, the shorts really contributed a lot to that. And believe it or not, the longs that we have, some of them are also not in the mainstream, and they're new ones that I've gotten focused on recently, things like consumer staples and Russell 2000 stocks. But yeah, the shorts really helped us out a lot. And to your point on Microsoft and Apple, last quarter, Q2 is sort of a good blueprint for what I see happening this quarter, which is you had some names that were talking up AI, et cetera, that didn't quite perform. And Microsoft, by the way, is one of them. Because if you look at what they did last quarter, when they guided for September in their intelligent cloud division, which has Azure, which is, all the AI related stuff, they actually guided slightly below the street for September in that intelligent cloud. And the stock went down, and it should have. And by the way, that's true for a lot of companies that you've seen. Oracle obviously had the biggest one-day drop, down 14% in a day after they guided below the street for both revenues and EPS for their upcoming quarter. This was the worst decline in over 20 years. So there's a real split between the people who are saying AI 50 times, actually having numbers go up gigantically like Nvidia, versus other names that are saying it, but you're not seeing it show up in the numbers because everything else is bad enough to offset it. And I think you're going to see a repeat of that this quarter where, we've said publicly we're short Tesla, we're short Apple, but we like Google. That's probably our favorite of the mega cap or Magnificent Seven going into earnings. We also own Amazon. That one's a little bit more of a battleground because it's a question of, I think the retail business is doing great, but I don't think AWS is going to be particularly good. And oil being up, hurts transportation costs. So we'll have to see what investors decide to focus on. But I do think Amazon's a share gainer in a tougher economic climate. And you've seen it with some of the press releases they've had recently talking about hiring 250,000 seasonal workers. Last year, they only hired 150,000. The year before that was only 150. Talking about Prime Day, where they talked about, it exceeded their expectations. It wasn't in their press release a year ago about Prime Day. And talking about 150 million units sold for third parties. And last year, that was greater than 100 million. And so I think retail is doing well, but I have a lot of concerns about the AI-related portions of the business because, yes, that's strong, but everything else is weak. And so you're having to balance this out. And it's, you're trying to figure out, well, what do investors actually care about? Because for me, the retail business longer term, that's what I care about. Because that's the majority of their business, but they're not making any money. So if they can get that to profitability and, driven also with a lot of the AI offerings they have, helping them out over a longer period, that's a positive. So we're I hate to put it this way, but we're managing the portfolio daily, seeing what comes in, seeing how stocks react to that information, and then processing that way. Okay, what are investors actually thinking? And then, managing the fund daily off of that. That's how we're, made money in July and August. Sorry, August to September, we made money in July too, but the market was up. But we're making money now in September as well. It's sort of that balancing act.
I want to stay on Amazon for 1 second here because I think the trading in the stock has been really interesting over the last couple of months. If we go back to when they reported their Q2 in early August, the stock gapped to a new 52-week high on the back of those operating margins in the retail business that surprised. And I know that when you and I spoke, earlier in the year, you were concerned about the deceleration in AWS and the competition that they have and the share loss that they've had to, a handful of other players here. And, a lot of folks were saying that, this thing should be troughing as far as AWS growth in the low teens or so. So my concern, if you just look at how the stock traded, it filled in that gap over the next few weeks as a lot of major tech companies did. But then it started rallying again on hopes in and around AI. Obviously, they made that Anthropic investment, and that came, much after that. But then the stock dropped like a lug, like 15% or so. So it's trying to stabilize here. This one is going to be, I think, probably one of the most volatile names of those Mag 7 that reports. And I haven't figured out like a conviction one way or the other, but I just thought the trading in the name that initially the excitement was on retail, and then it got into AI, and then obviously we have some of this FTC stuff and going on, and I don't think that's meaningful. I don't think you probably do anytime soon.
There's one piece you left out, Dan, that's, come out in my world, which is a lot of people that track, that supposedly have some decent information on how AWS is doing because they've got, methods that they're using to try to track it, is showing AWS is decelerating. And so that's really what drove a lot of the downdraft in the stock over the last month or so, is when some of that data started to come out. And, as I said to you, I go, well, I care about the retail business because that dwarfs the size of AWS. But remember, last year, they lost money in the retail business. They made no money in AWS. They made more than 100% of the profits in AWS. So I sort of get it for investors, but what I think people forget is that Amazon used to make money in retail. Then they had this massive buildup during COVID. At the same time, they're building up this infrastructure while e-commerce demand is dropping, right? The post-COVID hangover. And so now all of a sudden they have these massive fixed costs in 2022 as well. While e-commerce demand is decelerating, last quarter you saw really a good sign of, well, hey, volume's picking up in e-commerce, and now profits are getting way better. And I think you're going to see that continue this quarter. But, to your point, I think this is going to be one of the more volatile stocks. And in full disclosure, I'm guessing I'm going to be long into it. I'm still trying to figure out the sizing. But, we'll have to wait and see the day before they report and where the stock is and all the rest of it. But do people care about AWS more because everybody's so caught up in AI that they're ignoring everything else? And so that's still something I'm trying to think through in terms of position.
But it's also interesting, that when we talk about the consumer, right, and some of the headwinds that you mentioned to the consumer, repayment of student, loans and interest rates higher for longer, and a whole host of other things, people being trapped in their homes, for good reasons, I guess, because they have very low mortgage rates. It wasn't that long ago, maybe just a couple of weeks ago, that some of these kind of Teflon retail stocks, and we know that most retail has acted like absolute dog shit, right, and most of the brands and that sort of thing. But when Walmart and Costco joined the party to the downside a few weeks ago, that was getting a little scary because, those were meant to be beneficiaries of the trade down and a whole host of other sorts of things. And so to me, yes, they've kind of recaptured much of that sort of, and it felt like a little bit of a panic, especially in Walmart, because, Target has been going one way. All these department stores have been going one way. Some of these brands got into it. The staples joined the party to the downside. So to me, I think it's good that Walmart has stabilized a little bit, that Costco stabilized, because it would not have been a great sign for Amazon if those things started like acting the way that many of their smaller sort of competitors were acting.
Yeah, and that kind of gets into a second thing we haven't talked about, which is you've got the two G themes. You got Chat GPT and you've got GLP. And so that second part feeds into Walmart, because when Walmart CEO came out and said, yeah, we see these weight loss drugs having an impact on our business, they just took the consumer staples sector apart, and a lot of retail stocks that, whether it's restaurants or you name it, that could be impacted by it, they absolutely crush. And so I think that also has had a lot of impact on retail. Now, the funny thing is this morning, you got the retail sales figures come out for the entire country, and they're incredibly strong, which is why you've seen the 10-year now all of a sudden gap back up to like 485 today, potentially pushing through its high. We'll see where it closes. And people are like, wow, retail's good. And this is sort of a more long dated issue in that you're not going to see a problem in retail because of weight loss drugs. Now, people may use that as an excuse, but it's not like there's a step function, between last quarter and this quarter in terms of the number of the people that are taking it. It's going to be a slow and steady increase that'll have some impact. I think the bigger issue is something you touched on, which is you've got 25 million people on October 1st that had to start repaying student loans out of 45 million people in total that have them. And that's going to impact demand into the fourth quarter. But I think that's going to be more impactful for things like, electronics, et cetera. And then you've still got high inflation as a backdrop. And, you go to the pump and oil's in the mid 80s to high 80s right now. And that's up from $67 back a few months ago. So that I think is much more impactful to demand when you think about the holiday quarter in Q4. And that's clearly something I'm watching despite my bullish view in terms of a rally through year end for technical reasons and seasonality.
Yeah. It's interesting. When that Walmart headline came out, I thought it was total BS. If you just think about it, I mean, yes, Walmart's been talking about trade down, and, there's some data out there suggesting that, the average, household income for a Walmart shopper is higher than it's ever been because of the benefit of that trade down. But, Pepsi came out quickly after when they reported, after, I think a week after that Walmart comment, and they said they're not seeing that. And so to me, I just thought that was interesting because I also don't think right now a Walmart shopper, if access to these GLP-1s is scarce, right? And insurance companies are not really covering them right now. A Walmart shopper is not spending $1,000 a month. They're just not. So,
my bigger question is, how does the CEO even know? Is he like taking a poll of all these customers and going, well, are you on GLP-1? I sincerely doubt it. So I'm like, how does he even know?
Yeah.
And so to me, that was my bigger issue with that statement.
Yeah, no, I thought it was definitely curious. You just mentioned the 10-year at 485, and so we're recording this. This is Tuesday afternoon, October 17th, and it looked like it wants to close the yield at the highest level it has in a couple of decades here. And, up 15 basis points, Dan. I mean, like, think about that, okay? Like, you and I have spent the better part of, the last 2 decades with interest rates, hovering below, 1% or so, at least Fed funds for the most part, right? And so 15 basis points at 485 at a cycle high here. If you put a gun to my head yesterday, okay, and told me that we're on our way to 5%, and crude oil's at 87 and the US dollar index is at 106 up from, where it fell off a cliff a couple, months ago or whatever, I'd tell you the S&P is at 4,000 or lower, but here we are, we're not far away from, 4,400. And I guess, does this get into some of these technical and seasonal sort of dynamics that you're talking about with the stock market?
Absolutely. And one of the changes I've sort of, if you don't adapt, you're going to die, right, as an investor. And one of the big changes I've done over the last 2 years is really focused on, well, what do I think will happen? Which a lot of times is a lot different than what I think should. And so what I mean by that is, to your point, do I think the S&P should be down at below 4,000? Absolutely. Because we haven't even talked about valuations, which is, if you look at the last 60 years of history when CPI has been between 3 to 4%, the S&P trades at about 17 and a half times. And right now it's trading at 20 times, right? So you're talking about a 10% correction right there from current levels, plus some. And then you throw in, you got things going on in Russia and the Middle East, et cetera. You could argue it should be below it. So that's what I think should happen. But what I thought, would happen is that people would be in this zone of, oh my God, it's the fourth quarter. I'm underperforming. The market's gotten completely washed out, on October 3rd, which is why we put out that tweet on the morning of October 4th. And so, there's that old maxim of the market's going to inflict as much pain on as many people as possible. And to me, it was going to rally off of oversold conditions. And that's unfortunately what it's doing, which is why I go back to, meets the three bears in 2024, because I think what'll occur is once companies have to report Q4 and some of this impact of higher interest rates, higher oil prices sapping, you're buying 25 million people having to repay loans. Then the rubber's going to hit the road when they have to report the fourth quarter. And I think it's not going to be pretty. But until now, you're just sort of putting the blinders on, ignoring it. And the more stocks go up, the more that people are short, feel like they've got to cover, the more the long-only portfolio managers feel like they got to chase. And I saw some survey this morning that you had like record levels of cash sitting with portfolio managers, and that's stuff that'll get deployed. So, I think that's what will happen. I think it's incredibly stupid, but that's what I think will happen versus what I think should happen, which is the S&P, breaks 4,000s at some point as we go through the rest of this, we get into 2024. But as I've said many times, I'm managing the portfolio daily. So much like, you're seeing how the market's reacting to this stuff, I'm looking at it as well. And it gives me increased conviction, unfortunately, that the market's just going to probably keep going up through year end.
All right. So right around the time you put out that tweet in early October, I had a scratch pad on my computer before CNBC's Fast Money. I was doing that. I had this. Okay. So I was just like kind of taking some notes before the show started. I had the S&P that was down 8% in the year, down 8% from its recent highs. The NASDAQ was down 7%. And I went by sector. Okay. XLK is tech, down 9%. XLE is energy stocks, down 9%. XLI, industrials, down 10%. Consumer discretionary, down 10%. These are all from the highs. XLF, bank stocks, which include Berkshire, is kind of funky, but down 12%. XHB, so home builders, down 13%. XLP, staples, down 13%. Transports, down 14%. Metals and mining down 15%. Real estate, was down 20%. XRT down 22%. That's retail. XBI, which is supposedly defensive. That's healthcare, right? Like stocks, down 23%. XLU, down 23%. The Russell was down 14%. This was about a week ago. And then the equal weight S&P was down 11%. And I probably missed a couple sectors there, okay? But that was kind of like how I was getting my mind set to talk about the show. And, at that time, the S&P was still up 11%, okay? So just think about all that, okay? So under the hood, before we get to some single names and kind of where you're kind of putting, some money to work, okay, specifically in tech, when you think about that, let's assume that plus or minus 2%, okay, in either direction, you know what I mean? Those sectors of, it's not good under the hood, right?
It's terrible.
Yeah.
It's terrible under the hood. Yeah. No, you're 100% right. And that's why I've talked about this before. If you go back and you look at the tech bubble breaking in 2000 and then the global financial crisis, the market went down, around 50% on average in both of those instances. But you had 5 rallies in the S&P that were between 18 to 21%. 5 separate on your way to losing half your money.
Yeah.
So the point is that this goes back to the whole thing of what do you think will happen versus what do you think could happen? And the problem is when you get oversold to these oversold levels, the market fluctuates between fear and greed. On October 3rd, you were at max fear. Now, by the way, I was on CNBC Squawk Box at the beginning of August. And I said, it wouldn't surprise me if there was going to be a 10% correction in the market. We laid out, we think rates are going to be higher for longer and inflation is going to be higher than people think, and et cetera, et cetera. And to your point, the market was down about 8% from July 30th, which was the peak near term, to October 3rd. And then at that point, we're like, okay, we've gotten to these oversold levels. And now, much like in 2000 or in, 08, you're going to get some sort of rally here. And then I think this will run out of steam by the time we get to Q4. But unfortunately, fundamentals don't matter in the short term, right? As you and I know, it just comes down to, oh my God, the stock's going up anyway. And so then I'm going to chase it. And then you have to report the quarter every 90 days. And then you have to reset reality to what expectations are. And that's why you've seen like Oracle go down the most in 20 years in a single day when they actually had to report. That's why I think this earnings season for the mega caps in particular, it could be extremely volatile because you still do have, to your point, Dan, under the hood, it looks terrible. And you've got 7 stocks, the Magnificent Seven, that have on average almost doubled year over year, holding the entire tape up. And if you end up with a colossal disaster at a couple of them, especially some of the ones that are really holding the tape up like an apple, which I think could be possible, it'll get very interesting very quickly, because then at that point, people will be forced to deal with the reality, as you put it, that under the hood, things look awful. So we'll see. I mean, we're dealing with this day by day, and
so
we'll see how
two things you just mentioned I want to hit on here. So you used the words, you were on your way to losing half your money. Okay, so the S&P got cut in half from its highs in 2007 to its lows in 2009, and it also lost half of its value from its highs in 2000 to its lows in 2002. And when I go back and I look, and you also just mentioned rates. So we have a Fed funds at 5.5%. It's likely to be 5.75 on the upper band by the year end. The last time, it was higher than that was early 2000. The last time it was in and around 5.25%, okay, was 2007. Okay, those are both instances where the S&P got cut in half. So let's just play this out a little bit. If all of these other sectors that we just mentioned, and there are very few that act particularly well relative to, let's say, these top 10 or 15, mega cap tech stocks and a couple of the GLP-1s, you put Novo Nordisk and Lilly together and you have $1 trillion market cap company. You know what I mean? That for all. So to me, that is also indicative of investors just like a moth to flame of those things that they can't quantify. Do you know what I'm saying? Like the pixie dust of AI. And again, I don't mean to be dismissive about AI, but we've seen a year ago when, before Lilly doubled, okay, the GLP-1 market, I think by the street, was like a $25 billion market. Now Goldman's out this morning saying 100. I've seen some people saying 150 by 2030, that sort of thing. So I guess my point is, under what conditions might the S&P over the next few years get cut in half again? Okay, so we just talked a little bit about the geopolitical stuff. All of that to me is inflationary, Dan. When you think about it, right, from commodities, from reshoring, from labor, right? I mean, the list goes on and on and on, okay? And then if you put in some shortages, that sort of thing. Listen, you and I, we do not want some sort of expanded sort of war in the Middle East. And I certainly hope that President Biden going to Israel is meant to be, this is going to be, by the time you're listening, he's probably going to be there as a calming sort of factor. He's basically saying to Hezbollah in the north, don't even think about shooting a rocket over here. He's saying to Iran, don't even think about doing anything here. He's also saying to Bibi Netanyahu, let's be cool here a little bit. You know what I'm saying? I hope that's what comes out of this a little bit, and then we can show a little restraint too. So hopefully that moderates to some degree. Hopefully the situation in Ukraine moderates to some degree. Hopefully things don't get dialed up with China, okay? But all of this stuff is going on at the same time, and if they all just get turned up 1 or 2 notches, it's going to be higher for longer on steroids. Talk to me a little bit about that. And then that speaks to the valuations in stocks here in the U.S. are literally being held up by 10 or 15 names. And everything else, you use that 20 times, they're all trading below 15 times. You know what I mean? All this other stuff, right? So talk to me a little bit about that. Under what scenario could we see things really get unwound in 2024?
Well, I mean, I think you pretty much touched on it. The one thing you sort of glanced on, which concerns me, is if I'm China, this is a great time to make a move on Taiwan. And I've said this for years now, that is going to happen. It is a question of when and not if. And, the good news is right now you've got air cover between Russia and now the Middle East, and you've got a presidential election coming. And so, I think there's a decent probability that something could happen in 2024, which would ratchet things up even more. With regards to rates, I think the thing that investors forget is over the last 15 years, post global financial crisis, the average 10-year is 2.4. So it's interesting right now, it's double that level at about 4.8. But if you look at it over 60 years, which is as far back as I've got data, that 10-year average yield is 5 point. And I've said this before, I think rates are going to be going higher because of not only a lot of what we've talked about, but you've got 50% more job openings than people unemployed. There's a reason workers are able to go on strike and get big pay raises. And so that's going to have to change quite a bit. You've got quantitative tightening. So the Fed balance sheet's down $700 billion in the past 6 months. You've got $2 trillion in government deficits next year, bonds that need to be issued. And then you got $5 trillion in bonds that need to be refinanced. That's a lot of supply. And then I started the year thinking Japan would get off of yield curve control. That was in my top 5 picks. And I think that's definitely going to happen as we get into 2024, which will push up bond yields even more. So it used to be Tina, right? There is no alternative to owning stocks. Now, if you can get a guaranteed return of 5% locked in for 10 years, that should look pretty good to you. But you've had literally, you could argue, 40 years where with bond yields coming down, it has made 100% sense to just keep taking more and more and more risk. And then you got to the global financial crisis and the Fed takes rates to zero, essentially, over a period of time, which makes it even more feasible to take more and more risk. And remember, under this scenario, inflation's coming down. And then you finally get to the point where people go absolutely crazy and they introduce things like modern monetary theory where you can run up debts infinitely and there's no bad impact. And it's funny how you don't hear people talking about that anymore when you got to 40-year highs in inflation. And so now that's dead. And now we're getting back into more a realm of reality. And so unfortunately, you've got 15 years of investors basically becoming addicts to low interest rates. And that weaning off process is going to be tough. And so you throw in a lot of what you talked about, and I have my views on what's likely to happen long-term, but obviously the long-term is made up of a lot of short-term events. And so, as I said, I'm trying to manage this day by day, but yeah, would it surprise me if the market got crushed? No, it won't. Obviously, if China gets involved with Taiwan and that escalates, or Hamas or Iran gets involved with this situation in the Middle East, that escalates. There's a lot of things that can happen. And so I think you need to kind of stay nimble in this tape. And to your point with the Magnificent Seven or 10 to 15 names, however you want to look at it, holding the market up, if you've got some earnings related issues with some big grouping of that, that's another thing that can set this off. I think it's more of a 2024 issue, but would it surprise me if it happened in Q4? No, but I think the market's showing that off of these oversold levels, it's able to ignore a whole bunch of stuff.
Yeah.
And it's doing it again today.
Well, no doubt. And, it's interesting. We'll get to today a little bit, but, you and I had a front row seat for, kind of that .com melt up and then melt down. And then also, for the financial crisis. And when I think about, the last time the S&P, had even tested, like, the fact that we went down 35% in 2 months or so in 2020, right, in and around what was the, we throw in Wall Street that term black swan event around, but we literally finally lived through a black swan event, which was COVID, right? For the economy, for markets and that sort of thing. And the S&P closed up on the year after dropping 35%. It was the quickest, drop.
It closed up 16% that year.
No, right. So to me, if you ask me, what the likelihood of a 50% correction in the S&P 500 is, I'm going to tell you what's changed for me is that, like, it would have to be a nuclear war. I mean that sincerely, because I hope that doesn't happen, obviously, you know what I mean? Or the use of a sort of tactical nuke, maybe because once they get used somewhere, they might start getting deployed in other places too. And that would really change this kind of, world order that we've had, since World War II in a way. I literally cannot foresee another financial crisis here in the U.S. I know that a lot of folks have been calling for one in China, and there's lots of evidence that they have one, but they have a very tightly controlled, as you know, economy there, and they can do a lot of things to kind of avert that. I just don't know what would do that again. I really don't, if it's not something that we couldn't foresee. You know what I mean? And so I don't know. I mean, I feel like down 20%.
I mean, here's the thing, Dan. It's always a process, right? I was on Wall Street during the 2000 to 2002 meltdown, and every 3 months we downgraded everything we covered in 2000, and I was negative for almost 2 years. And every 3 months the market would have a rally. Every 3 months people would call the bottom. This went on for 2.5 years. And I upgraded about 3 months too early. In like June is when I started upgrading of '02. Market bottomed in October. But, that was a long, drawn out process. And so I think to some degree, you and I don't have to worry about what makes the market go down 50%, because it's going to be a process. It's going to take some time, and you're going to get a bunch of rallies, and you'll have people always calling the bottom and saying we're going to go up. But I think here's what it ultimately comes down to. The stock market's really simple. It's earnings times valuation. Valuations are high relative to where inflation is. You know that you got 50% more job openings than people unemployed. That's going to put downward pressure on multiples. And the earnings are ultimately going to be impacted by the fact that you got wages going up enough, commodity prices going up enough, because all this green stuff is great for the environment, but it's horrible for costs. And then you throw on top of it all the onshoring or nearshoring or friendshoring, whatever you want to call it, and building a fab in Arizona, which is why TSMC is pushing it out, is twice as expensive to get chips out of there than getting a fab out of Taiwan. And so all of this stuff that used to be, and don't forget, China had their first decline in population in 60 years. And so you're taking away cheap labor overseas. That's not the case anymore with lower birth rates. You're taking away cheap energy because of green energy. That's gone. And then you're taking away offshoring, which is now nearshoring, which is more expensive. So all these trends that have been deflationary for 40 plus years, they're now inflationary. And I think that gets to why I think you could have multiples overcorrect to the downside. But it's a process. It's not something I spend much time thinking about. But that's when I kind of put it all together, because who in the late 90s with all these tech IPOs and the internet's going to change everything, and it's eyeballs that matter and for valuations. And then NASDAQ goes down 78% from peak to trough during that period of time, while the internet is, by the way, changing everything. And Amazon goes from 106 to 6 while the revenues are double. So I've seen a lot of stuff. And that's why it wouldn't surprise me, because I think you've got 15 years where the view is, well, the stock market went up 16% during COVID, so it'll never go. And there's so many people in their 30s and 40s that I talk to that say, well, the government will take care of it. I'm like, their hands are tied with inflation. The government doesn't have the same capacity that they used to.
No doubt. All right, let's talk about a name that you're positive on, and this is a stock that I believe the S&P could go down 25%, the Nasdaq could go down 30%. This stock would double to the downside, and this is Nvidia. Now it's one you're positive on, and I just want to be really clear here that obviously the stock's up 200% on the year. It's a $1.1 trillion market cap. Expected earnings and sales growth for calendar 2024, over 50%. Okay, so it's trading at about 25 times. That seems really reasonable. And a lot of folks like you, as it's been marching higher all year long, and you've been long it, and it's been working for you, okay, you've been saying it's going to grow into a valuation. But then if you look at the out year beyond that, right, in 2025, expected 20%, earnings and sales growth or so. And to me, this is one where this is going to be a moving target, in my opinion, okay? Like, all of their customers are moving so quickly to develop their own advanced GPUs, right, to train their models and to go into their supercomputers and the like here. And I just feel like the enthusiasm around this stock, 60 buy ratings, 3 holds. The stock's trading at 440 right now. It's down 5%-ish as we speak on Tuesday afternoon because of further restrictions by the Biden administration on these advanced GPUs to China, and specifically the ones that were tweaked to be sold to China. Okay, so at one point it was down 7% or so. Today, I look at the universal optimism about this company. I look at all of the customers and competitors who have all the incentive in the world to kind of figure this out. I know you just can't figure it out. I get it. You know what I mean? And I know the software ecosystem in and around, you know what I mean, these chips that they've been able to create. But I just make the point that these guys were telling a great story around crypto mining. And then they were telling a great story around data center. And then they were telling a great story around gaming. And then they were telling a great story around metaverse. Okay, all, you know what I mean? Like this is the last 5 years, Dan, right? So, and from its highs in 2021 to its lows early this year, maybe late last year, it lost 75% of its value. Okay, so I guess my point is like this could happen again, like lots sooner than the Nasdaq or the S&P could get cut in half, in my opinion. So,
well, this is what I would tell you, and this goes back to what I think will and should have. It will happen. They're going to come out sometime in 2024, and you're going to have supply having caught up with demand. And much like a year and a half ago, they're going to start missing them. Because there's definitely double and triple order. That's clear. And you're not going to have double and triple ordering going on and at the same time have worries about Amazon Web Services, which is the biggest public cloud vendor on the planet. Those two things don't coexist. So that is going to occur. But here's the other side of this. Remember, it's only trading at about 30 times. It's 25% below the long-term average. And what I would say is, as a hedge fund, there are a lot of other names. Like I look at that and I go, okay, so I can buy Nvidia at roughly 30 times next year. Let me just double check it. Yeah, 29 times next year. Now I go, they're growing revenues 84% this year. They're looking at 58% growth next year, and we'll see where that turns out. I said, okay, and I can pay 29 times for it. With Apple, I can pay 26 times next year and get 2% growth last year, no percent growth this year. The numbers have been coming down for 9 months. So for me, I'm like, I'll short Apple. I can put that up against Nvidia because I look at the computing space, the smartphone space, and I go, I've got computing stocks trading in the single digit P's. For me, it doesn't, like last year we made money. NASDAQ's down 33%. We were net long. We made money because I don't really care about Nvidia in a vacuum. I care about Nvidia relative to other names. And remember, these guys, unlike every other company that's saying AI 50 times, and TSMC, by the way, giving you a great example, this is last quarter. I think numbers are fine this quarter, but TSMC is the foundry for Nvidia. Last quarter, they reported and they took down revenue forecasts. At the same time, Nvidia comes out, they report, and they beat, they take up July by 53% in terms of revenues for the July quarter. They beat the July quarter by 21% after already having raised it 53%. And then they take up the October quarter by 27%. So for me, it's about matching up positions. And so I 100% agree with you that at some point, this double, triple ordering will stop. But right now, there's not even close to enough capacity to meet the demand. And so I think as long as the numbers keep going higher and as the valuation keeps getting lower, because the numbers are going up faster than the stock. And to your point, the stock's down from where they reported those blowout numbers. I just have to match it up with other stuff that I think has got a much bigger problem. And AI is real, much like the internet was real. But to your point, Dan, NASDAQ went down 78% from peak to trough from 2000 to 2002. And, AI, there's going to be some shakeout between every company claiming they're an AI beneficiary to those that are actually benefiting. And so I think you and I are saying kind of the same thing, but it's not expensive. And I think that's the thing I would point out. And I try to compare it to Apple, given it's the most valuable company in the world and the relative growth rates there. to show the company.
Well, I mean, listen, the only point, and I know that you are very nimble, and I know that you are, kind of matching themes up long and short in the book. The point that you made about Microsoft's intelligent cloud and the guidance that they gave, if Nvidia, no matter how good the quarter that they just completed or they're going to complete at the end of October when they report in November, if there's a similar sort of trend, right? Like, in a handful of...
They're not going to have a trend like that. They're going to beat and raise by a lot. The question is, how does the stock react? And if you look at last quarter, the stock was barely up that day. It started on its highs, closed on its lows. It was up, I think, 0.1% after reporting those blowout numbers. So the stock action can be a lot different than what the fundamentals are. But what I would tell you is that if Nvidia starts to act like that, there's a whole bunch of other AI related names that don't have that kind of upside to numbers. And I would bet you that they're going to be down a lot more that day. And hopefully I'm short those teams making money anyway.
Right.
So
we'll
see what
I just think the incremental buyer for Nvidia here, like, I don't know where it exists. That's kind of my point. Without massive beat and raises that surprise the upside. I want to hit a couple names before we get out of here. I really appreciate your time so far here. So Apple, you mentioned that there could be something lurking there. It's interesting as we speak. Tim Cook is over in China right now. He went to some Tencent gaming forum. The headline the other day was that the 15 sales are not tracking nearly as well as the 14 last year. I think this is a theme that you and I touched on, and we can also touch on it as far as Tesla is concerned, is that, again, these are going to be two of the last battles fought between us and China. When you think about from a manufacturing standpoint, when you think of a supply chain standpoint, you think of access to this, Chinese consumer and the like here. Is it a coincidence that Tim Cook happens to be over in China right now at a time where, the headlines are not particularly great as it relates to demand for their smartphones? And, listen, there are plenty of local competitors at much cheaper price points that have access to all the stuff that Chinese consumers want, these sort of super apps that our friend Elon is dying to turn Twitter into, which, I don't think he's going to be able to do that. So let's talk about Apple for a minute here and what your expectations are into the quarter.
Apple's really simple. It trades at 30 times, as we talked about before. The S&P is at 20. You had 2% revenue growth last year. You had 0% growth this year. You've had 3 down year-over-year quarters in a row. They guided September to down for a fourth consecutive quarter year-over-year. They haven't had 4 down year-over-year quarters in a row, I think, since 2001 or 2002. So it's way too expensive for where it trades at. The bigger issue in your mind, it should be the following if you're an Apple investor. In 2019, Huawei had about 16% global market share for smart. Donald Trump went ahead and put in those sanctions. That market share went from 16% to below 2%. They introduced a new high-end smartphone, just a few months ago, which is selling incredibly well. And so that 16% share that went to below 2%, Apple got some of it at the high end because Huawei, they were at the higher end. And so, everything you've heard about the Huawei phone is it's selling incredibly well. Again, it's all homegrown chips, et cetera. And so what if the share goes back from 2 to 16? Apple's going to have a huge problem because China's a big market. So then you have people saying, well, yeah, but they're going into India and you've got this big installed base. Well, guess what? They've been going into India over the last year and the revenues are still down year over year. The installed base has been going up and the revenues are still down year over year. They are trying to push into services and the revenues are still down year over year for the total company. And by the way, India's average GDP per person is about like 1/10 of what it is in the United States. And it's less than, I think it's like 50% less than what it is in China. They barely can afford the iPhone, never mind the services. So you look at all of this, and none of this would matter if it was at a 10 PE like a Dell or an HP or an HPQ, but it's at 30 times. And so, the thing I point people to is it's a process when things change. And don't forget, in fiscal 19, before COVID supercharged their revenue growth, their revenues in fiscal 19 were down year over year because the smartphone market is saturated. And on top of it, you've got iPhones that are still overheating. And that's even with the fix.
Yeah, the nonsense The nonsense, though, about these upgrade super cycles that all these sell side analysts, that's how they justify the seasonality of their trade. It's so dumb. And especially when you think about how people are paying for iPhones these days through all these, monthly plans and everything like that. I mean, to me, it doesn't make a lot of sense. And, my partner Guy Adami likes to say all the time, when Apple was a growth stock years ago, it traded at a value stock valuation. Now that it's a value stock, it to me, I agree. It doesn't make any.
Well, the problem is people have tried to convince themselves it's somehow consumer staple stock.
Yeah.
You can own it forever.
Yeah. Well, look what just happened to Staples. I mean, look at Pepsi just sold off 25%.
Well, forget that. I'd say, look at what happened to Disney.
Yeah. Yeah.
Right. Disney hit a 9-year low. And I think of all the people, and I think of the seminal event is when ESPN, this was, I don't even know how long ago, I want to say 7-8 years ago, came out and said, yeah, we're losing subs. And that was just a shudder throughout the space because it was assumed that sports was the one area of media that was unassailable. And it's been a slow decline since then. And people still go back to, oh, you got to own Disney. And yeah, you can make a sum of the parts argument, but until somebody's actually willing to break the company apart, it doesn't really matter. It's a great business school argument. And it hasn't stopped the stock from going to a 9-year low. And so I look at Apple and I go, well, at the end of the day, the growth is the growth. And this is where you're sitting. And if you want to pay 30 times for it, be my guest. But that to me is incredibly risky when, you look at PC companies that are trading in the single digit Ps. And, quite honestly, we're looking at some of them because we're going, well, you know what, we may actually with Windows, people having to move to the next generation because the current one's getting discontinued, et cetera. Not the current one, but one going way back. Maybe there is a mini upgrade cycle going there and things get better. And at a single digit PE, that's interesting versus, Apple sitting at a 30. And so to me, it's all about risk versus reward. And to me, it's just not there for Apple. If it was at a single digit PE, then yeah, I'd definitely be more interested in it, but that's not where it's sitting. And it's not a consumer staple. I think we're going to figure that out when Q4 results come in. And with overheating phones, in the developed markets, I don't know how that's something that a consumer wants to buy for $1,000 either.
No doubt. All right, before we get out of here, let's hit Tesla here because this is one that I think you said on CNBC recently, and we've talked about it before. You are short, and this is a company where, to me, if I'm just looking at, I'm not looking at Dojo, and I'm not looking at full self-driving and AI capabilities and all this sort of stuff. It's a car company who's seen its margins go from 25% automotive to probably 17% when they report on Thursday. So they are feeling the effects of the competition specifically in China. And, there was an article in The Information, and I just was looking for it here, and I read it quickly the other day. It was talking about how Xiaomi, okay, so it's another cell phone maker in China, as that has decent market share. I think it's number 2 behind Huawei. I think it's correct. How they're going to be releasing, an electric car that's going to be autonomous. It's going to be a massive shot across the bow for Apple and their 10-year ambitions with Titan. And I'm reading this article and I'm saying to myself, this is not a shot across the bow at Apple. We don't even know what Titan is. This is a shot across the bow at Tesla. I don't know if you saw this article, because if you think about it, and the competition there is massive for them. And if we do have nationalistic tendencies that are working into their consumers, that might be evident with what we just mentioned with this Huawei phone, right? And with this shadow ban of Apple phones or this ban of Apple phones by government agencies in China. Well, they're going to get to Tesla soon enough. And that Tesla's September sales in China were down 11%. Somebody was reporting that over the weekend or so. So to me, this one seems like an accident waiting to happen. The only other point I'm going to make here real quickly, and I'm going to let you go, is last week there was an article in CNBC.com about a whistleblower at Tesla in 2021. I don't know if you caught this, but this is about some of the financial shenanigans that a lot of the bears have been suggesting have gone on for years. Well, you know what also happened in the last couple of months? This longtime CFO resigned on a Friday. It was a Friday night dirty, right? You remember that a few months ago? And with no explanation whatsoever. So I'm not trying to be all conspiracy theorist here, but to me, it seems like the fundamentals are not great at this company. And you know what? Elon should go back to just I know that Falcon Heavy just took off this morning or something. Go back and do that, man. Be the genius that we all know you to be. I know you think of him very highly. That's how we ended our last pod in August.
Yeah, I mean, look, I have a Model X Plaid. It's the highest end Tesla. I think Elon Musk is this generation's Thomas Edison. I think he's absolutely brilliant. But I'm short the stock. And, at the end of the day, it's sort of like with Apple. Well, it's different than Apple in that Tesla's actually growing revenues quite rapidly. But I think the biggest problem, honestly, with Tesla is where rates are. What I mean by that is most people buy cars on installments, they borrow money, financing plans, et cetera. And you combine that with, have we gotten to the early adopters where a lot of people can't have a Tesla because there's no place to plug it in. If you're parking it on the street or a parking garage, it doesn't have that capabilities. And there's some signs that EV demand is kind of slowing. If you look at the regular car companies, a lot of them are going more to hybrids, which instead of just pure EVs, because that gets you out of this sort of range uncertainty. I plug mine in, every night. And so I don't have that issue, but I'm not going to take it on a long trip because of that problem. And, the valuation is high. To your point, margins have come down from the mid 20s into the teens. And Elon, rightly or wrongly, has said he's happy if they don't make any money on the cars because he's looking at the longer term play of robo-taxis and Doja and everything else, which is all well and good, but I don't think shareholders would react particularly well to that. And you've seen the price cuts. They missed their delivery numbers. And again, I think it's sort of risk versus reward. It's not a big short for us because obviously the stock is driven more by sentiment than, fundamentals to some degree in the short term. But on a relative basis, I'm fine being short that. And don't forget, we haven't talked about some of the longs that we have, but, besides Nvidia, we're long Google, mid-teens PE, we're long Oracle, 20 PE, Microsoft by comparison is at 32 times, we're long Amazon, long, NVO and Lilly, but we're also having other end of the barbell, which is the hated name. So we have a basket of Russell 2000 stocks. We have a basket of consumer staple stocks that got demolished off of the whole drug obesity stuff. So we have sort of the barbell at that end too. And that's how we're looking to try to make money between now and year end. And, obviously watching oil prices, as I've said multiple times, that's why I wake up every morning. It's the first thing I look at because I go, if oil's up, market may have more issues. If it's down, it'll probably be fine. That's my number one thing. And, so to me, matching Tesla up against some of my longs,
No, that makes sense. And I mean, the thing that Tesla is interesting to me is that you just mentioned your Model S Plaid that is probably $110,000, $15,000, $20,000 car. And
I wish it were that cheap.
Well, right. All right. So it starts at that and depending on range and the like here. And, what's interesting to me though, is that they probably sell in America, maybe tops, 5,000 of those a quarter. Okay. Like, I just want to be really clear on that. Right. So I think on the high end, like they're selling thousands of those. Okay. And I think to myself that they're going to make their bones. You mentioned robo-taxis. Well, they have to get to a $25,000 car, right? So that's the Model 3 or whatever this next thing is. And I think that this Cybertruck thing is a sideshow, okay? Like, I just don't think that like a lot of people have $100 deposits on them and this and that, whatever. So at the end of the day, if you think about where they're going to make those low-end cars and where they're going to sell them and then where they're going to deploy the robo-taxis that are going to be built on the Dojo and the full self-driving and all that sort of stuff, it's China. I mean, like, so where they have all the competition. And so the last thing I'll just say is that if I had $125,000 to drop on a 4-door fully electric sedan, okay, let's call it that, I'd be going straight to that Porsche Taycan. Okay, like I think in a blind taste test, okay, or drive test or whatever, I think that's what most people are doing. And then when they see them also, and the last thing, I know this is a bit of a rant, I'll just say is like, I try to get Teslas all the time for Uber because I'm amazed at how shitty the Model 3s are. The actual like the seats and the rattling and all this sort of stuff. I mean, they're crap, dude. And like, people who know cars, they are crappy cars. So on the low end, where they need to dominate, right, to get this thing to mass market, where the whole valuation makes sense, the cars aren't good. So I don't know. I mean, to me, I know that was a little much, wasn't it, Dan? But
I think that was a lot much because what you have to remember is you can say that, but at the end of the day, the revenues for Tesla were up 51% last year, or they're up another 22% this year. And so, this is an app where Apple's got no growth. I mean, people are buying this. The thing for me is that I think the price point, the range anxiety, where rates are driving financing costs, to your point, competition in China is real, which, by the way, is the biggest market for electric vehicles in the world. And so having homegrown competitors, that's an advantage for them. Those are all things you need to consider along with the valuation. Now, don't get me wrong. We owned Tesla for the first time in a couple of years at the beginning of this year. I clearly should have held on to it for longer than I did. If you look at the price, but so I have nothing against Tesla. I obviously admire the company and Elon immensely, but I just think those big picture things that are going on right now, and I've got alternatives. That's the beautiful thing about the stock market, where I can own a Google or an Oracle or an Amazon, where I think numbers are pretty solid here, hopefully. That gives me a good matchup. And, we don't have a lot of shorts, and Tesla's one of them. And we'll see how this shakes out. So,
well, listen, Dan, I appreciate you coming back every quarter. We just covered so much from the macro to a bunch of your individual, longs and shorts, and I love hearing how you manage your portfolio. I think a lot of our listeners really enjoy that too. You tend to be really nimble, and you don't wait around for mistakes to happen. I think we all get caught off guard here and there, but that whole notion of not listen, people say that thing, trade the market that you have, not the one that you want. I think your nuance is a lot better with thinking about it. You know what I mean? Like the way you kind of detailed it from a single position standpoint or a macro standpoint. So listen, I really appreciate you coming on and giving our listeners the benefit of your experience. And obviously the performance has been fantastic. So Dan Niles, you are the founder and portfolio manager at Satori Funds. I really appreciate you coming back to OK Computer.
My pleasure to be on, Dan. Thank you for having me. Take care.